Returns from most asset classes were positive over the quarter. Developed market equities added 0.5%, led by Japan. Investment grade bonds added 0.9%, and global listed property added 3.5%. However, if we compare this to the first half of the year, when equities added approximately 17%, the pace of gains has clearly slowed, and there were areas of weakness during the quarter, as well as large intra-quarter swings across all major markets. All of the Harmoney portfolios delivered strong gains over that period of strength in the first 6 months of 2019, but the third quarter presented a more varied picture across the range. The majority of portfolios posted gains, ranging from 0.7% to 1.4%. The US dollar and Asian portfolios declined though by between 0.3 and 2.8% in US dollar terms. The variation was mostly driven by differences in local equity market returns. The US lagged the reasonable gains produced by other developed markets over the quarter, while Asian equity markets declined. Despite this quarter of more mixed performance, year to date to the end of September, all of the portfolios are up by between 6.1% to 14.5% in base currency terms and net of fees. The most significant changes were made during July when we lowered the exposure to equity markets across all portfolios and added to fixed income holdings. The overall effect was a meaningful reduction in the portfolio's level of risk and sensitivity to equity markets, which was well timed as it helped protect against the subsequent drawdown through late July and August, when stock markets around the world fell sharply and bond markets strengthened. These changes followed on from our investment team's latest asset allocation review, where we debate the macroeconomic and investment environment and formulate our outlook. We ultimately took the view that equity markets were not fully reflecting the various downside risks to global growth. Our medium-term outlook remained constructive, but we felt that some consolidation in markets was overdue. By reducing risk at that point, we put ourselves in a position where we will be able to add to risk assets when a better opportunity is presented. We also made a change to our liquid alternative holdings in July, where we eliminated our position in the Aberdeen Alternative Risk Premium Fund and added the proceeds to our existing holding in the Neuberger Berman Uncorrelated Strategies Fund. We feel that the Neuberger Berman Fund deserves a higher weighting given it is a more diversified strategy, which itself provides exposure to 7 specialist managers, most of which are difficult to access otherwise. We believe that this updated blend of 3 alternatives funds, held across all of the Harmoney portfolios, is more robust and offers strong diversification benefits, both relative to each other and particularly relative to other assets across the portfolios. Finally, in September, we added a new holding across most of the portfolios in the Merian Chrysalis Investment Company. This is a closed-ended investment trust that owns a concentrated portfolio of private companies in the UK and Europe. The trust targets well-established businesses and even market leaders in some cases, but these are still typically smaller companies because they have a niche business focus and are earlier in their life cycle compared to the average listed stock. The team looks to invest in genuinely disruptive capital-light businesses, growing at a rate which far exceeds that of most public companies. The portfolio currently has exposure to around 10 companies, which have a weighted average growth rate in excess of 50%. The trust is run by Merian's specialist small and mid-cap team who have extensive experience and an outstanding track record from investing in similar companies for well over a decade. We're excited about the potential for this strategy. Although reflecting the higher levels of risk involved, we have sized it conservatively in portfolios with allocations of between 1 to 3%. Key to market moves in recent months has been the indisputable evidence of a broadening global manufacturing recession. Trade wars and disruption in the critical auto industry have damaged the manufacturing and export powerhouses, with China's growth falling to its lowest level in almost 2 decades, and Germany in or very close to recession. Business investment has weakened and the slowdown has spread globally, with growing fears that the much larger consumer and service sectors will be impacted. Another risk factor that remains front and centre for markets and is holding them back for now is around geopolitical uncertainty, most notably emanating from the Middle East and the UK. But with inflation subdued, central banks have considerable flexibility in keeping policy ultra loose for much longer, thereby extending this extraordinary cycle. Slower for longer and rates lower for longer. Indeed, central banks have responded to this slowdown by easing monetary policy materially, including recent interest rate cuts from both the US Federal Reserve and European Central Bank, and the market's view that there will be further significant easing from the Fed and ECB is unlikely to be disappointed. However, there is growing recognition of the negative consequences of extraordinary monetary policy, and calls for governments to contribute stimulus in the form of greater fiscal spending are becoming much louder. But caution is warranted in the short term. Equity and bond markets have risen sharply this year, and valuations have become stretched in some areas. Yet, the economic backdrop has deteriorated. Risks of a broadening slowdown and recession have increased, and corporate earnings are under pressure, especially in sectors most exposed to manufacturing. A period of consolidation is overdue and likely, but we believe that the cycle has further to run, and there is very strong valuation support from the extraordinarily low yields on cash and bonds, something which we expect to persist for a considerable time ahead. This represents a strong case for staying invested, while also ensuring genuine diversification in portfolios to provide protection from the risks and inevitable periods of shorter-term setbacks.